Are you still convinced that home ownership in America is a guaranteed long-term investment? A lot of men were raised on that promise. Work hard, buy a house, hold it long enough, and it becomes the cornerstone your family's safety, your retirement plan, your proof that you built something real. That story still sells. It still sounds right. It still feels like common sense. But what happens when the foundation of that promise starts cracking, not in the usual coastal headline markets, but in Pennsylvania, the state that was supposed to be the dependable middle, the place everyone treated like it couldn't blow up because it never ran too hot in the first place? That assumption is breaking. Across Pennsylvania, the housing market is shifting in ways that don't look dramatic until you zoom out. It's not always a crash you can point to on a chart and say, there it is. It's slower, and that's what makes it dangerous. It's the grind. Listings sitting longer, price cuts stacking up, deals falling apart after inspection, sellers lowering the number again and again because the buyers who used to show up fast simply aren't showing up anymore. And behind those market signals is something deeper than interest rates. This isn't just a speculative bubble story. In parts of the state, it's a long-running economic erosion finally reflecting itself in property values. Industrial abandonment, population flight, shifting labor markets, and public infrastructure that's aging out at the same time. Household budgets are tightening. By 2026, the problem in some towns won't be that homes are cheap. It'll be that they're hard to sell at any price that makes sense once you factor in repairs, taxes, insurance, and the absence of the next buyer. That's the real threat, not the price tag, the lack of demand behind it. This is across.us4. If you want to spot the fault lines before they become front page news, subscribe now. Today, we're breaking down Pennsylvania's most vulnerable housing markets, places where home values are sliding, where the math is getting ugly, and where one bad purchase can trap you in a market that's shrinking while everyone else is quietly moving on. This isn't about fear. It's about leverage. In a market that's turning, the guy who survives is the guy who understands what he's buying, what it costs to carry, and who the next buyer will be when he wants out. Let's get into it. Number 10, Lancaster. Lancaster has always sold an image. Historic streets, brick row houses, a downtown with energy, and farmland just beyond the city limits. For years, it felt like the perfect compromise, more affordable than the big metros, but far stronger than the Rust Belt towns that never recovered. Then the migration wave hit. As people got priced out of larger markets, Lancaster became the smart alternative. Remote workers arrived. Long-distance commuters came running the numbers. Investors showed up with cash and confidence. Offers got aggressive. Buyers paid over asking, waived protections, and treated inspection reports like a formality. Prices moved fast, but Lancaster's incomes didn't move with them. That mismatch doesn't stay hidden forever. It shows up in the listings. Homes that used to disappear in a weekend now sit for weeks. Sellers list high. The showings are light. The feedback is cautious. And then the reductions start. A small cut becomes another cut, then a bigger cut, until the market finally admits what wages already know. And Lancaster has a hidden cost that gets glossed over in the charm narrative. Older housing is expensive housing. The photos look great. The ownership reality is different. Old electrical, aging plumbing, worn roofs, drafty windows, foundations that have survived a century of weather. During the buying frenzy, plenty of people told themselves they'd handle it later. Later is now. Repairs cost more. Labor is more expensive. Materials are more expensive, and the buyer pool is more cautious. That combination puts pressure on pricing fast. On the rental side, the ceiling is real. Tenants can only absorb so many increases before they start looking outward toward nearby townships. And if you own a rental, one vacancy can wipe out months of projected profit, especially as taxes, insurance, and maintenance keep climbing. Lancaster hasn't lost its appeal, but buying here today isn't an automatic win. It's a balancing act in a market that's correcting downward while carrying costs creep upward. Number 9, York. York has always lived in the orbit of larger markets. Harrisburg to the west, Baltimore within reach to the south. For a long time, that made it a value play. More space for the money, solid old housing stock, and a manageable commute, if you could tolerate the drive. During the boom, York drew a different crowd. Investors and out-of-area buyers saw low entry prices and sturdy brick architecture. Renovations spiked. Larger homes got chopped into rentals. Some buyers paid numbers that local wages couldn't support, assuming appreciation would do the heavy lifting. For a brief stretch, York looked like it had finally caught up, but the local job market didn't transform at the same pace as the housing market. When borrowing got more expensive and household budgets tightened, the limits became obvious. Listings started sitting longer. Price cuts became routine. Sellers who anchored their expectations to peak sales have had to come back down to earth, and York has real structural friction. Older homes with decades of deferred maintenance, mechanical systems near end of life, and in some pockets, environmental or infrastructure questions tied to industrial history. Insurers notice, lenders notice, buyers are learning to notice. Affordability isn't just the mortgage. It's the full monthly load principal, interest, taxes, insurance, utilities. In older, drafty homes, utility bills can be a silent killer. When the total monthly burden climbs too high, buyers walk. That's what creates the slow bleed, not a dramatic collapse, but a steady loss of leverage for sellers. York still has opportunity for buyers who truly know the neighborhoods and understand the numbers, but the era of cheap equals safe is gone. Number 8, Erie. On paper, Erie has a permanent advantage: the lake, freshwater coastline, public beaches, sunsets that look like they belong in a magazine. Most cities would kill for that, but real estate doesn't run on scenery. It runs on jobs, population stability, and confidence that someone will want what you're buying after you've carried it for a few years. Erie has been dealing with long-term economic headwinds, industrial decline, population loss, and uneven reinvestment. When the national housing surge hit, outside interest rose. People saw low prices, lakefront potential, and a chance to buy early into a comeback. The comeback has been inconsistent. In stronger pockets, certain corridors, select neighborhoods, some properties still hold up. But broaden the view, and the softness shows up quickly. Longer listing times, reductions that come in waves, and sellers discovering that demand is thinner than they assumed. Erie also has a climate tax. Harsh winters punish roofs, basements, driveways, and foundations. Freeze-thaw cycles don't care what you paid. If you bought without a buffer, one major repair can tip the budget into crisis. That's how distressed listings enter the market, and distressed listings drag down comparable sales. Rentals aren't a simple bailout either. There's a ceiling on what renters can pay in many neighborhoods, and heating older buildings through long winters can eat the margin alive. Erie will always have the lake, but that doesn't guarantee appreciation. In a turning market, it can mean you're buying a long-term bet on a community that's still fighting to regain momentum. Number 7, Bethlehem. Bethlehem is built on reinvention. Steel made it famous. When steel faded, the city repurposed its legacy into tourism, arts, and a lifestyle story walkable streets, historic architecture, university energy, proximity to New York and New Jersey buyers. That success attracted money, and money changed the math. Out-of-state buyers came looking for a better deal than what they could get back home. Investors chased student housing and short-term rentals. Prices rose quickly. Row homes that used to trade at reasonable numbers became competitive. Now, the stretch is showing. List prices in many areas don't align with local income reality. Buyers have become more selective, less forgiving, and far more cautious about renovation-heavy properties. Homes on busy roads, tight lots, or with expensive deferred maintenance are taking longer to move, and sellers who keep anchoring to peak pricing are getting trapped on the market. Bethlehem also has a vulnerability most investors underestimate. Demand tied to tourism, festivals, and discretionary spending can cool fast in a slowing economy. And as communities tighten rules around short-term rentals, investor math can change overnight. Bethlehem isn't collapsing, but it is cooling, and that matters if you bought under the assumption that the revival story guarantees your exit price. Number 6, Scranton. Scranton has been a symbol in American culture for old economy decline. That label is incomplete because the housing market here did move, especially when prices elsewhere got out of reach. Scranton's low barrier to entry attracted first-time buyers and small investors. For a while there was real momentum. Improved streets, new storefronts, a sense that things were stabilizing. But the regional economy remains fragile. A lot of local jobs cover the basics, but don't comfortably support big monthly payments or serious renovations. When borrowing costs rose and everyday expenses tightened the squeeze, the buyers who stretched to get in found themselves living closer to the edge than they planned. In 2026, that pressure shows up in the pattern: longer days on market, price cuts that have become routine, deals falling apart after inspection or financing hurdles. Homes priced realistically for condition and location can still sell. Homes priced like it's the peak era sit. Scranton's housing stock adds risk. Many homes are older, oversized, and expensive to modernize. Getting them energy efficient and code compliant takes capital. Buyers who underestimate those costs get punished. Investors who misread renovation budgets get stuck with stalled projects' empty units that weigh on neighborhood perception and value. Scranton can still work for disciplined buyers, but it's not a cheap, therefore safe market. It's a market where fundamentals set the ceiling, and in weaker areas, that ceiling is getting lower. Number 5, reading. Reading has lived through economic cycles like weather. Manufacturing strength, then decline, then warehousing and logistics, then new waves of disruption. The housing market has followed that uneven rhythm for decades. In recent years, Reading attracted buyers searching for value locals, trading up, and outsiders hunting for a price point they could still afford. Prices rose off low levels, and that created the impression that stability had arrived. But stability isn't a feeling. It's a base of income, employment, and buyer confidence. And right now, Reading shows warning signs: listings sitting longer, reductions appearing in stages, distress sales never fully leaving the landscape. Reading also suffers from a split market reality. Some blocks hold value better. Others slide quickly based on school perceptions, safety concerns, and neighborhood upkeep. Families might stretch for a district they trust, but they won't pay premium prices for uncertainty. Investors face a narrowing runway too. The old playbook by Ruff, stabilize, refinance, repeat, has less room when appraisals tighten. Lenders get cautious and renters can't absorb constant increases. Reading is a classic trap for the casual buyer because it looks affordable. The real benchmark isn't cheap compared to New York. The benchmark is supported by local incomes. When prices drift above what residents can carry, the market corrects slowly, then suddenly. Number 4, Harrisburg is the capital. That label has always implied safety government jobs, legal firms, steady institutional presence. The assumption was that Harrisburg wouldn't swing wildly because it had a built-in economic engine. Then the boom years arrived, and even Harrisburg caught the fever. Development picked up, renovated row homes, and new builds rode cheap borrowing and demand from remote workers. The city's boring but safe reputation gave way to something closer to urgency. Faster sales, higher prices, bigger expectations. Now the market is recalibrating. Prime locations still attract interest, but the broader market is cooler. Price cuts are common. Days on market are longer. Negotiation is back, and sellers who expect the old frenzy are getting humbled. Harrisburg also sits at the intersection of two rising cost pressures that reshape housing decisions: insurance risk and commuting cost. River proximity can be appealing until rainfall patterns, runoff, basement issues, and insurance premiums enter the conversation. Meanwhile, suburban expansion relies on affordable commuting. As fuel, tolls, and vehicle upkeep rise, long drives become less attractive. Harrisburg isn't collapsing, but it's transitioning into a more skeptical market where capital city stability is no longer a free pass. Number 3, Allentown has been marketed hard as a comeback story: redevelopment, modern apartments, a revitalized downtown, proximity to larger metros. While the narrative held, rising rents, rising prices, more attention. But by 2026, the situation looks more complicated. New supply, investor pressure, and affordability limits have narrowed the margin for error. Buyers aren't paying premium prices just to buy into the story anymore. They're scrutinizing schools, safety, parking, taxes, and neighborhood stability. Some new buildings still lease well. Others need incentives to keep units filled. On the ownership side, properties in quieter residential areas hold better. Homes on high-traffic corridors or in inconsistent neighborhoods face resistance and deeper cuts. Allentown also shows a reality many men respect because it's concrete. A city can look revived on the surface while still struggling underneath. When you have blocks that feel renewed sitting next to blocks that feel abandoned, appraisals get messy, buyer confidence gets shaky, and price growth becomes unstable. Allentown can still succeed long term, but right now, the highest risk is in areas where marketing and hype pushed pricing beyond what local wages and living conditions can support. Number 2, Pittsburgh. Pittsburgh is one of Pennsylvania's strongest cities on paper. Healthcare, higher education, technology, and a cultural identity rebuilt from its steel past. For years, it was treated as underrated and obvious long-term hold. That belief drew capital. Investors crowded into neighborhoods near universities and hospitals. Out-of-state buyers chased trendy areas, convinced they were catching the next breakout city early. Prices climbed quickly in the very neighborhoods that had historically been the affordable entry points. Now, Those same neighborhoods are where the adjustment shows up first. Bidding wars cooled into negotiations. Sellers, anchoring to peak comps, have been forced to recalibrate. Deals can fall apart after inspection when buyers uncover expensive maintenance realities, especially with Pittsburgh's older, distinctive housing stock. Because Pittsburgh charm comes with Pittsburgh costs, steep lots, retaining walls, complex foundations, aging mechanical systems. When borrowing costs rise, fewer buyers are willing to accept those risks at premium prices. Pittsburgh has real strengths, but it's not immune to the basic rule. When a market outruns its fundamentals, it corrects. And by 2026, the correction is most visible where excitement pushed prices the furthest. Number one, Philadelphia. Philadelphia is number one because it concentrates nearly every housing pressure in the state into one sprawling, complicated system. Historic row homes next to luxury towers, struggling blocks a few streets from booming corridors, neighborhoods that can change from one intersection to the next. During the cheap money era, Philly became a magnet, investors chasing yield, first-time buyers stretching for a foothold, developers rehabbing and building across huge portions of the city. For a while, it looked like everything rose together. That phase is over. In many neighborhoods, values are bending downward. Homes that once sold immediately now sit. Reductions are common. Properties needing updates or burdened with tight layouts, lack of parking, low ceilings. Old systems are taking the hardest hits. At the same time, ownership costs are rising. Taxes, insurance, utilities, and constant maintenance for older housing stock. A lot of buyers assumed they'd refinance later or repair over time. But cheaper financing isn't there in the same way, and repairs don't wait. Quality of life factors sharpen the pressure, safety concerns, school performance, city services, transit reliability. For some buyers, inner ring suburbs now look like a better total value deal when you compare the full monthly cost and a lifestyle stability. Investors feel the squeeze too. Short-term rental rules have tightened in parts of the city. Rent growth hits ceilings. Maintenance costs rise. Legal delays and operational friction make easy cash flow harder than it looks in a spreadsheet. Quietly, some landlords are selling simply to reduce exposure. Philadelphia isn't disappearing. It remains the state's powerhouse. But the housing market has shifted into a phase where pricing is no longer climbing by default. Now, here's where we go deeper, because Pennsylvania's vulnerability isn't limited to the 10 cities everyone talks about. There's another layer, towns and smaller cities, where the issue isn't merely prices are softening. It's that the economic base has been eroding for decades and housing is finally reflecting the reality. These places aren't always dramatic. They're quiet. And quiet is often where the real risk hides. Wilkes Barre. Wilkes Barre has scenery and history, but a large portion of its housing is exposed to environmental and insurance pressures that buyers underestimate. Flood mapping, drainage problems, and coverage changes can turn a good deal into a property you can't afford to keep. When insurers tighten terms or pull back, buyers disappear fast. That's when values don't just soften, they drop sharply because financing becomes harder to secure and carrying costs jump. Johnstown's story is the long aftermath of industrial decline and demographic shift. Older housing, aging infrastructure, and an older population create a market where sellers can't easily exit and buyers hesitate to commit. A single failed inspection septic, foundation wiring can derail a deal, and in a weaker demand environment, that property can sit for months. That's how affordable becomes illiquid. Aliquippa shows the harshest truth of post-industrial America. When a town loses its economic engine and doesn't replace it with a comparable income base, housing becomes a liquidation market. Prices can look tempting, but remediation costs, lead, asbestos, old mechanical systems can exceed the purchase price. And if the population continues to decline, the next buyer may not exist when you need them. Chester is the final warning label because it exposes the difference between cheap housing and functioning market. When poverty is concentrated, services are inconsistent, and the tax base is weak. The hidden costs grow. Liens, deferred municipal upkeep, safety concerns, and financing friction. In those conditions, low prices don't signal upside. They signal risk transfer, meaning the buyer is taking on burdens the system can't cover. So what does all of this mean? It means the American assumption that a house automatically becomes an appreciating asset is not a universal law. It's a conditional outcome. It works when the community grows, when jobs support wages, when infrastructure holds, and when the next buyer exists. When those conditions weaken, housing stops behaving like an investment and starts behaving like a liability. Something you carry, repair, and defend, hoping you can hand it off later. And that's why this matters for Pennsylvania right now. Because Pennsylvania was never sold as a high-risk place. It was sold as the stable place. But stability is not a slogan. It's an economic structure. And in many parts of the state, that structure is under strain. Here's the pattern repeating across the map. Home prices rose faster than local incomes. Investors pushed boundaries and treated old problems like they didn't matter. Aging housing stock and outdated infrastructure got ignored during the rush. And now the reset is underway. Not always as a crash, often as a slow-motion recalibration. Price reductions, longer listing times, inspection-driven renegotiations, and incremental losses that stack up for anyone who bought near the peak. If you're watching this as a buyer, the conclusion isn't never buy. The conclusion is buy like a professional. Stop looking only at the purchase price and the monthly mortgage. The real cost is the full carry, taxes, insurance, utilities, maintenance, and the capital required to prevent the property from degrading. Stop trusting the story and start verifying the fundamentals: job growth, population trends, school stability, infrastructure condition, insurance availability, and comparable sales that aren't inflated by peak era emotion. Stop assuming demand will rescue you. Ask the hardest question: who is the next buyer? And what will they be able to afford in this neighborhood, in this city, in this economy? Because a house is not just a structure. It's a bet on a community. And in Pennsylvania today, some communities are holding up. Others are drifting. And a few are entering a phase where the real danger isn't that homes get cheaper. It's that they become harder to sell, harder to insure, harder to finance, and harder to justify. That's not the end of the American dream, but it is the end of the American autopilot. If you want to protect your money, your family, and your future, you don't buy based on hope. You buy based on reality. And reality is shifting quietly, brutally, and inevitably one price cut at a time.